This is Through a Trader's Eyes with Karl Eggerss, and thanks for joining me. Appreciate it. For those of you that are new to the podcast, we appreciate you joining us. And on this podcast, we're just going to talk about, in general, since it is the weekend here and it's a Saturday, we're going to talk about really what happened not only in the prior week, but really where the market is when we kind of zoom out. During the week, it's very easy to look at what's going on and comment on that particular day to determine, how the market has been doing or what made it move that particular day. And now what we want to do is kind of zoom out and just see where we are, because the rally, people have immediately turned from bullish to bearish in just a couple of days. It's amazing how quickly people's emotions swing from one side to the other, and how depressed they are. And then all of a sudden they get very elated that the market is going up, and then they swing back to pessimism. So it's kind of this optimism, pessimism pendulum. But here we have the S&P 500, and of course, it's really went down pretty much every day this week. Not a lot, but you can see that this uptrend that had been in place since June is now at least in jeopardy. And the bulls would say, well, it's just a pause, and the bears would say, no, we have a double top here. This was a time where the stock market should have busted through, and it didn't. And so now that is your ceiling. And of course, we certainly had this uptrend in place, and maybe that's broken. So these are all things that the bears are looking at. From a bullish standpoint, the S&P is sitting right at its 50-day moving average, as you can see, and it's been hasn't been a huge meaningful line, at least in the last few months. I mean, you can see we broke above it here and then back below it and then back above it, bounced off of it here, and never really came near it. And now we're sitting right on it again. So it's hard to say if that's a meaningful moving average in the short run. In the long term, the 50-day moving average is probably the most meaningful moving average. At least that's the one that I see most people reference. And so, again, it's one of those self-fulfilling prophecies. If most people reference it, most people are using it, and they're going to trade around it. But we're sitting at the 50-day moving average. But really, kind of what I'm seeing is, we broke out of this old high right here. Remember, that was before QE3. That was in, I think it was a jobs number. I don't exactly remember what it was, but the volatility was very tight in this. We'd been moving sideways for 10 or 12, 14 days, trading days straight, just real tight range. And then it busted out, and you didn't know if it was going to bust out to the upside or downside. A lot of people thought we were at a double top here, and here, and it started to roll over, and then it busted on through. And then, of course, QE3 was announced, and that was this day. And the next morning, we opened up, faded, and it's been really down ever since. And so many believe that it was kind of a buy the rumor. That's what all of this rally in here from June, July, August, September was all based on the Fed announcing QE3, which they did. And now that rumor is fulfilled, you are selling the news. I personally think it's way, way too early to call this a top. If we zoom in here, a couple of things that I'm noticing. I mean, first of all, yes, we do have this kind of sideways pattern that we're in. We're on the bottom end of the range, and we're now just back out to the old breakout area. So, I mean, the logical thing for this market to do would be to maybe come down one more day, breach the 50-day moving average, cause a little bit of spike in the volume, a little more panic, so to speak, and then we rally again. I think ultimately this rally isn't over yet, and the reason I say that is because back in late September, early October, the market was very, very overbought. And that just meant that, some of these oscillators that we watch were stretched. It just was too many people leaning one direction. That is now starting to work off. It is probably, maybe 60 or 70% of the way done as far as working it off. And yet the stock market has only sold off maybe 3% from its high. The old high here, which was 1474, and we're at 1428 right now. So it's about 50 points or so. It's not a huge move. It's about 3.5%. So what the benefit is that we're seeing this sell off without any real depreciation overall. The negative side is we're still seeing deterioration as far as it's pretty broad spread. You're seeing selling this week. We saw selling in things like healthcare, which had been just very, very strong. I mean, if you look at healthcare for year to date, this is what it is. It's been moving straight up, but you saw a little bit of weakness here in the last in the last few days. So that's starting to show some signs, at least, of a temporary pullback. Another strong area, gold. That got very, very overbought. And now what you're seeing is a very tight range again, where gold is trading in this very tight range, and I think it's about to break out one way or the other. It may have shown its hand yesterday when it was down, almost 1% yesterday, that it could be falling off the edge here and could pull back a little bit. Ultimately, I think gold goes higher, and it's because of not only the quantitative easing and more stimulus, but it's still an area where money's flowing into, and I think it's still seen as a safe haven. The thing is, when you go back a year on gold, we're at a top, and so it wasn't a real stretch to go, okay, well, gold may pause here temporarily. And that's why, I had mentioned in the podcast, I had taken some profits on gold miners, I don't know, a week or two ago, because it had gone vertical, and it went vertical and took profits, and I want to buy them back, and I think I'll get a chance to do so. And I'm thinking that it may be where this 50-day moving average is coming into play here, right in here. So again, what's happening with all this, as you can see, is the moving averages are moving up, but the market's just kind of moving sideways to slightly down a little bit, and it's working off of that overbought condition. It's working it off to where you're getting an entry point in the future that may not be a whole heck of a lot lower than we are today. So I don't think we should toss in the towel. We're not in a screaming bull market. We know that. We're in a market where, again, I want to reiterate that, especially for people who are new to the podcast, we're in a long-term secular sideways, you could even call it bearish market, that's been in place since year 2000. And it's been in place. And even, an elementary school student would look at this and say, well, I can tell by this picture that this was a top, this was a top. And if you said, well, what's the pattern going to be here? I think my second grade daughter would say, well, I see this, and 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 say, what's the next logical move? And they would say, well, it's this, isn't it? And we've talked about that in the past. Maybe, maybe not. I think there's a very good chance we at least go to the high. But this is one issue that the bears have with this market right in here. Look at this volume dropping off, continuing to drop off as we've moved through. Through 08, 9, 10, 11, and 12, I think what's happened is a lot of people have simply left the stock market. They simply are not participating anymore. I don't want to be there. I don't want to participate in the stock market. And so you're seeing the volume dry up. Even with the high-frequency trading, even with the computer algorithms and everything, the volume continues to get worse and worse. Now, I've always been a proponent of looking at whatever the volume is. Yes, I would like high-volume rallies, but look at the quality of the volume. And what we've been seeing recently is that we've been seeing decent strength in the last couple of months in the markets, but we're still seeing some areas that have rolled over. The transports have been an area that have really struggled during the last couple of months. As you can see, look, from January of this year, the transports have continued to just, show overall weakness. And this is kind of the range we're in. And so they're kind of in the middle now. They got oversold and they bounced a little bit here. But we're in this range where they're just moving sideways and going down, and the moving averages are starting to go down. We reached up to 53.50. We got down to, under 5,000. So they've been selling off. And so that's a problem. Obviously, everybody knows what's going on with coal. And now that coal is so oversold, you're seeing people saying, hey, maybe it's bottoming. And you can see I've drawn this line on the coal ETF. It's kind of zigzagging back and forth. And a lot of people believe, hey, this thing is bottoming. Here's the problem, though. When I change this to a weekly picture, look at what's happening. This thing has rolled over since back in mid-11 when this ETF was around $50, and it's at 25. It's got cut in half. Okay, and depending on how the election goes, depends on whether this industry is going to possibly thrive once again, or maybe go away or diminish severely. So coal's at an inflection point, but my point in showing you specifically coal is that there are several sectors and stocks that have rolled over and are in bear markets already. And that's what happens when an old bull market becomes a bear market. Sector by sector, stock by stock, gets weaker and weaker and weaker. And that has happened. Now, that doesn't mean that the bull market is over today. That does not mean that at all. What it means is maybe we're in a process where here's '09. We're in a process where this is, remember, this is a 3-year bull market that has run, and we are past the typical expiration of bull markets. They usually run for about 3 years. And this started in March of '09, and here was March of 12 roughly. That's 36 months, 3 years. And we've gone on past that. It doesn't mean it's going to end tomorrow, but the point is it's a mature mini bull market. And I say mini because we've been in kind of a sideways market since 2000. But from '09, when this little bull market started, this thing is getting mature. It's long in the tooth. And so what happens is it starts to mature and sectors start performing weakly. But what happens is that takes several months to play out. So we could reach new highs on the S&P 500 very easily and still be in a market that's slowly and gradually rolling over. So what we want to do is we want to participate in that. And how do we do that when we know we've got the fiscal cliff coming up in January? Doesn't seem like anybody's doing anything about it. We have an election, in a few weeks. It's going to be a kind of a fork in the road as far as policy. It doesn't necessarily mean the market's going to go haywire, but we've got a fork in the road in the bigger picture. And we have a bull market that's run for 3 years. So how do we still participate but know we have those issues out there? And one way is income. We know that. We've preached that for years. High income, and having that, you should be able to get your yields up to 4 or 5, even 6% on your portfolio, to where you have that cash flow coming in that A, acts as a buffer, and B, can help out with the total return. But what you want to do is, in conjunction with that, you want to be trading things. And trading things doesn't mean on a day-by-day basis. I owned Eli Lilly, which I thought was a good, deep value stock. And this was a stock that I bought because it was just cheap to me. It was a cheap company. I parked it in there. At the time, it had over a 5% dividend yield. And this thing started to finally move in 2012. It was running up slowly but surely. And then all of a sudden, things started to really pick up because of an Alzheimer's drug, and the trials were going well, and this, that, and the other. And this week, you can see what happened here is that it really spiked up a few days in a row here. And so what we basically did was, once it spiked up there, we basically said to ourselves, you know what, we're going to give it a couple more days to see, because sometimes these spikes keep going. But and this is an hourly picture, by the way. But so we saw this, and we said we're going to put a stop in there. And so once it turned around, we put the stop in, and we got stopped out, and we took, I think, a 25 or 27% profit and moved on. So even though I still like Eli Lilly, what happened was it had fulfilled basically what I thought or wanted it to do. It was an undervalued stock. I thought it was worth so much per share based on their cash flow, based on the debt they had, all of these things we look at from a fundamental standpoint. Bought it, waited for it to get to this level that was fairly priced, and then sold it. And now we move on to something else. So that's one thing to do. And of course, there's also technical pictures where you basically look at it and say, hey, this is something that we're buying low, selling high, we're going to buy it back. That would be, for example, the GDX trade that I was talking about. It ran up after it had this kind of double bottom here. It ran up, and then it's pulled back, and now we're looking to get it back again at some point, maybe hopefully a couple dollars lower. So those are real short-term trades. Then I think what you do is you want to complement the portfolio with the best sectors or the best areas to be in. For example, we know right now that that S&P 500 has been one of the best areas to be in. It's not real exciting, but the reason it's been one of the best is because people have flocked to safety, dividends, large caps. Look, if large caps aren't doing well, more than likely small caps aren't either, because those are the companies supplying the small caps. But these companies have dividends, and so there's a lot of safety there. So S&P has been one of the best places to be. Obviously, gold has been one of the best places to be, and it's just pulling back a little bit now. Healthcare has been one of the best places to be. Energy has been one of the best places to be. And financials have been one of the best places to be. And what we saw this week was all of those areas have sold off. And that's okay. They're selling off across the board, and it's not a major sell-off, but they're pulling back a little bit, but you still want to stay in the strongest areas if you're going to stay in there. And then the next component of a portfolio should have some cash for the rainy day, so that when we do get these pullbacks, you put it to work. You should also potentially have some long short ideas. If you don't do it yourself, you buy a manager that is able to go short. So you put all these things together, and what you end up getting is a little bit of a smoother ride instead of trying to have one strategy that fits all. If you're a person that loves to buy deep value stocks, sometimes that works, and then there's other times it doesn't. On the other hand, some people love momentum, and so when they buy momentum stocks, guess what? A week like this week comes, and it's pretty painful because they get hurt really badly because they obviously have rolled over, and the charts can change very quickly. So I think you use a multi-strategy approach, and that's your best way to get to where you want to be long-term, and you're not so dependent on the day-to-day movement in the market. Yes, you're going to move day-to-day a little bit, but again, if you're flexible enough, you're not going to have to worry about what the market did on Friday. And a lot of people base their portfolios on what it did on Friday or Monday or Wednesday or next week. And really what it's about is the income coming in, the big picture. And what I'm seeing in the big picture, again, on the S&P is that I think this bull market is maturing, but I still think we make new highs because what I've seen is more of a garden variety pullback lately. It's not been a very intense pullback. Now, the caveat to that is that you may want a big intense pullback because that's usually what leads to rallies is when you get kind of a freak out session and people go, I need to run for the hills, and volume spikes up. That's when you get a real bottom. So the fact that we're just trickling down, it's kind of a negative, but it's also a positive that we're not seeing the intense situation like we saw last July and August. It's just, to me, so far looks like a garden variety sell-off. But you have seen the breaches of the 50-day moving average. Of course, the Qs breached it pretty convincingly, and that's something that a lot of people are watching this technology. But look, that's all about Apple. Apple has pulled back and basically broke down a little bit. But, for somebody like me, yeah, I trade Apple a little bit, but I pretty much am looking at this picture, which goes back several years. And really since 2009, this picture has been intact. So you could go down to 570 and still be within a bull market in Apple. So the iPad mini is probably set to come out 10 days from now, October 23rd, and that will be a game changer, I think. And it's going to be a game changer. It could be a game changer for Apple in a negative way. It could cannibalize themselves. Who knows? We don't know yet, but the fact that they are right before the holidays coming out with a new product that's going to be $199, I think, and compete with the Amazon Kindle is huge. I mean, the timing of this couldn't be better for Apple to get in there right before the holidays, and for the people who are in the Apple atmosphere and buying all of these Apple products because they want to have everything talk to each other and just work. They know how it works, whether it's a computer, whether it's an iPhone or an iPad. Now they have the iPad mini, and that's a nice alternative for, let's say kids. I'm not buying my kids one. I'm just telling you that some people don't want to spend $600 on an iPad, but they'll spend, $199 on an iPad mini. So it's interesting to see what they'll do. It's still not an extremely expensive stock. Yes, it is a cult stock, and it's one that a lot of people would love to short. But it's due for a little pullback, and that's okay. It's just you have to determine, are you wanting to trade that or own it? And for me, I'm erring on the side of owning it more than trading it. There might be other things like gold miners we've talked about where you want to trade it because they're so volatile. And Apple really isn't that volatile if you think about it. If you divide the stock by 10, it's moved from $71 down to, or $70 down to $63. It's been a 10% pullback, but it hasn't been as dramatic as people on TV think. I saw articles this week about Apple that it was crashing. Apple was crashing, and I was just laughing, thinking, really? There's plenty of other stocks out there that are moving on a percentage basis much, much worse than Apple. But, it gets those types of headlines. So just remain flexible in this market. And, again, there's people out there that are in this buy and hold mentality, and they've done pretty well this year in January, or from January until now. But then what happens is when you start to get a pullback like you're getting right now, they don't know what to do because they have one strategy, and that is to buy and hold through thick and thin, and you get sell-offs like we had in May through June, which was 7 or 8% pullback, and then we had the big correction, which / bear market, which was 20 or 22% pullback last summer. And in that situation, they go, I don't know what to do because this is all I do. You have to have different strategies for different time frames, and again, kind of look at this market almost in 4D. And if you do that, I think you'll be much more successful over the long run. There's going to be months, there's going to be quarters, there's going to be years that you may perform differently than the market. But what you're trying to do is continue with a multi-strategy approach, because over the long run, it is proven, at least to me, that it's much, much safer to do it that way, and you will make more money over the long run, especially when the market starts to have some really awful times. And we haven't really seen that in the last couple of years. Yes, we've seen we've seen summer sell-offs, really in 2010, 11, and 12. These are the last 3 summers. Summer of 10, of course, started with the flash crash, and then it bottomed out. Summer of 11 started with debt downgrade and all of that, bottomed out. And then we had a smaller one this summer, and it bottomed out. So we've had these sell-offs, but it hasn't really changed the overall picture of the market here. Once we get that, that's when the buy and hold people, that's when the people that don't appreciate income will have a really, really tough time. And right now it hasn't been that way. It's been some scary times, but the overall market hasn't been awful. And those times will come again, unfortunately, and so you have to be ready for it. All right, guys, have a great weekend. I appreciate you watching, listening, and feel free to email or comment or whatever you'd like to do, and we'll get more of a back and forth dialogue going on here. And some of you send me questions, and I try to answer those in the podcast. But have a great, great weekend. We'll talk to you soon.